You check your savings account and the number looks solid. 10,000, maybe 20, maybe 50. It's there. It's stable. It hasn't moved much, and that stability feels responsible. You followed the advice. You built the emergency fund. You didn't spend recklessly. You did what they told you to do. And while you were being careful and prudent, something else was happening, something quiet, something that nobody warned you about when they said to keep 6 months of expenses in cash. Your money was dying, not quickly, not dramatically, just steadily, predictably, mathematically. Every year, the number in your account stays roughly the same while everything that number can buy shrinks. The grocery bill gets higher. The insurance premium climbs. The restaurant you used to visit costs more. Your $10,000 is still $10,000, but it buys what 8,000 used to buy, then 7, then 6. The erosion is so gradual you barely notice it happening until one day you realize that the safety you thought you were building was actually a slow leak you couldn't see. This is not an accident. This is policy. Central banks openly target inflation rates. They announce it. They measure it. They adjust their actions to achieve it. 2% is the common target, which means they are explicitly telling you that they intend to reduce the purchasing power of your cash by roughly half every 36 years. That's not a conspiracy theory. That's published monetary policy that you can read on government websites. And here's what makes this particularly brutal. The same people who tell you to save also tell you that cash is safe. They call it your emergency fund, your rainy day money, your security. And in one narrow sense, they're right. Cash doesn't fluctuate. It doesn't crash. The number stays the same. But stability of number and stability of value are completely different things, and most people confuse them. Run this calculation on your own savings. Right now, take whatever you had in your account 5 years ago, adjust it for cumulative inflation over those 5 years. Compare that to what you actually have today. The gap between those numbers is what being responsible with cash has actually cost you. For most people, that number is surprisingly large and surprisingly painful. There's a different way to think about money. A small group of people, and it is genuinely small, approach this completely differently. They don't see cash as the destination. They see it as one position in a larger game. They understand what cash is for and what it isn't for. They know when to hold it and when to deploy it. They've structured their lives around three specific assets that do something cash cannot do. They preserve value, they grow value, and they compound over time in ways that make inflation irrelevant. The first asset takes about 15 minutes to understand and maybe an hour to set up. The second requires changing how you think about what it means to own something productive. And the third, this is the one that almost nobody talks about, is the most valuable asset you'll ever hold. It can't be taxed away, can't be inflated away, and can't be taken from you. And if you get this one right, the first two become almost automatic. Let's start with what's actually happening to your cash right now, because you can't fix a problem you don't understand. When you put money in a savings account, you think you're preserving it. The bank shows you a balance. That balance doesn't change much. Maybe it earns a tiny amount of interest, 0.5%, 1% if you're lucky. That feels safe because the number is stable. Here's the reality. That stable number is denominated in a currency that is being deliberately devalued. Inflation isn't something that might happen. It's something that is engineered to happen. The Federal Reserve has an explicit 2% inflation target. The European Central Bank has the same target. They are telling you openly and directly that they plan to make your money worth less every single year. Now, 2% doesn't sound like much. It sounds manageable, but compound that over time and the numbers become brutal. At 2% annual inflation, your purchasing power is cut in half in 36 years. That's one working lifetime. The money you saved at age 30 is worth half as much at age 66. If inflation runs higher, which it often does, that timeline compresses. 3% inflation cuts your purchasing power in half in 24 years. 4% does it in 18 years. You might be thinking, well, my savings account earns interest. Doesn't that offset inflation? Let's check the math. If your savings account pays 1% and inflation runs 3%, you're losing 2% of purchasing power every year. That's guaranteed. It's not market risk. It's not investment risk. It's mathematical certainty. You are guaranteed to get poorer in real terms while your nominal balance stays the same. This is where people get stuck psychologically. Loss aversion is one of the strongest cognitive biases humans have. We feel losses about twice as intensely as we feel equivalent gains. Watching your account balance drop from 10,000 to 9,000 would be emotionally painful. But watching your purchasing power drop from 10,000 to 9,000 while the nominal number stays at 10,000, that doesn't trigger the same emotional response because you don't see it happening. The damage is invisible, which makes it psychologically easy to ignore. But invisible damage is still damage. Think about what this means practically. Let's say you've been diligent. You've saved $50,000 in cash over the past 10 years. You feel good about this. You've been responsible. But over those 10 years, if inflation averaged 3%, your 50,000 can now buy what about 37,000 could have. Bought when you started. You worked hard to save that money. You delayed gratification. You made sacrifices. And the system quietly took $13,000 of purchasing power from you while you weren't looking. This isn't theoretical. This is happening right now to everyone holding significant cash. And it never stops. There's no pause button. There's no exception for people who are being responsible. The devaluation is continuous, relentless, and completely predictable. So if cash is dying slowly, what do? You need liquidity. You need access to money for emergencies. You need some stability. The answer is not to hold zero cash. The answer is to understand what cash is actually for and to use the right tool for the job. This brings us to the first asset that beats cash at its own game. Short-term government securities, specifically Treasury Bills. These are loans to the U.S. government with maturities of 1 year or less. They're as close to risk-free as anything in finance gets because they're backed by the full faith and credit of the U.S. government, which can print dollars to pay you back if necessary. Default risk is essentially zero. Here's why this matters. Treasury bills currently yield somewhere between 4 and 5%, depending on maturity and market conditions. Compare that to a typical savings account paying 1%. That's 3 to 4% more per year for taking essentially the same risk. On $50,000, that's an extra $1,500 to $2,000 annually. That's real money for doing nothing except choosing a slightly different place to park your cash. But the real advantage of Treasury bills isn't just the higher yield. It's what they represent strategically. Cash sitting in a savings account is just sitting there, rotting. Treasury bills are doing the same thing, waiting, but they're working at a reasonable rate while they wait. This is a critical distinction. You're not holding Treasury bills to get rich. You're holding them because they're the most efficient form of dry powder. Think of it this way. Cash plus courage equals opportunity, but only if you're patient enough to wait for the right opportunity. Most people can't do this. They have cash. They feel pressure to put it to work. They see the stock market going up and they feel like they're missing out. So they deploy that cash into mediocre opportunities just to feel like they're doing something. This is exactly backward. The goal is not to be busy. The goal is to be ready. And being ready means having capital available when genuine opportunities appear. Those opportunities don't come often. They come during periods of dislocation, panic, and fear when most people are running away from risk rather than toward it. That's when assets get mispriced. That's when you can buy quality at steep discounts. But you can only do that if you have capital ready to deploy. Here's a real example. Think back to March 2020. COVID panic was peaking. The stock market was in free fall. High quality businesses that had been trading at 25 times earnings were suddenly trading at 12 times earnings. Airlines, banks, industrial companies, everything was getting crushed. If you had cash ready, you could buy incredible businesses at prices that seemed absurd within months. But here's the key: you could only take advantage of that opportunity if you had two things: capital that was liquid and available, and the emotional fortitude to buy when everyone else was selling. Most people had neither. They either didn't have cash because they'd been fully invested, or they had cash but were too scared to deploy it because the world felt like it was ending. The person holding treasury bills instead of cash wasn't just earning a better yield while they waited. They were demonstrating the patience required to sit on their hands until a genuine opportunity emerged. Treasury bills matured, cash was available, and when prices got absurd, they could act while others couldn't. This is what differentiates investors who build real wealth from everyone else. It's not intelligence. It's not access to secret information. It's patience combined with preparation. You hold treasury bills because you're explicitly waiting for the world to panic and offer you something wonderful at a stupid price. That might take years. Most people can't tolerate that kind of waiting. They need action. They need to feel productive. They need to do something. And that need to do something destroys more wealth than almost any other force in investing. Practical implementation is straightforward. You can buy treasury bills directly from the government through Treasury Direct. No fees, no intermediaries, no complexity. Or you can buy a treasury only money market fund through any major brokerage. These funds hold only short-term government securities and typically yield close to what treasury bills yield, minus a small expense. Ratio. How much do you hold in treasury bills? That depends on your situation, but think about it in two buckets. Your emergency fund, money you might need in the next 6 to 12 months, belongs in treasury bills or equivalent. This is not money for investing. This is insurance against job loss, medical emergencies, unexpected expenses. It needs to be liquid and safe. Treasury bills accomplish both while earning a reasonable yield. Your opportunity fund, money you've set aside to deploy when investments become attractive, also belongs in treasury bills. This is your patience made tangible. This is the ammunition you're saving for when targets present themselves. The size of this fund depends on your conviction and your situation, but having some amount set aside specifically for opportunities gives you the freedom to act when others can. The mistake most people make is not holding treasury bills. It's holding too much for too long and never actually deploying it. Or worse, getting impatient and deploying it into something mediocre just because sitting still feels uncomfortable. Opportunity requires preparation, but preparation without execution is just hoarding. This brings us to the second asset. Treasury bills are the waiting room. Great businesses are the destination. But understanding what makes a business great is where most people get completely lost. They look at stock charts, they look at recent performance, they look at what's popular or what analysts recommend, and all of that is noise. The only thing that matters is the quality of the underlying business and what you pay for it. So, what makes a business great? One characteristic dominates all others: pricing power, the ability to raise prices without losing customers. This is the ultimate economic moat because it means the business can pass inflation directly to customers and maintain or grow its margins. While your cash is losing purchasing power to inflation, a business with pricing power is gaining purchasing power because its revenues grow faster than its costs. Think about what this means practically. Inflation is running at 3%. A business with genuine pricing power can raise its prices by 3% or more. Customers grumble, but they keep buying because the product or service is valuable enough that they can't or won't switch to alternatives. Revenue grows, earnings grow. The business generates more cash. That cash can be reinvested, paid out as dividends, or used to buy back shares. All of those outcomes benefit you as an owner. Contrast that with a business that has no pricing power. Inflation pushes up its costs. Labor gets more expensive. Materials get more expensive. Energy gets more expensive. But if the business raises prices, customers leave. So margins compress. Earnings stagnate or decline. The business struggles, and your investment struggles with it. The difference between these two types of businesses compounds over decades into completely different outcomes. A business with pricing power becomes more valuable over time in real terms. A business without pricing power becomes less valuable over time, even if the nominal stock price stays flat. Let me give you a specific example. In 1972, a certain investment partnership bought a candy company for $25 million. The business was doing about $31 million in revenue and earning about $4 million in pre-tax profit. Most analysts would have looked at this and seen a slow growth, mature business in a declining category. Candy consumption per capita was flat or falling. There was no obvious growth driver. Paying 3 times book value for this seemed expensive. But the partnership wasn't buying growth. They were buying pricing power. This candy company had a brand that customers loved. The product was associated with gifts, with special occasions, with quality. And because of that emotional connection, the company could raise prices every year. Without losing customers, over the next 40 years, that's exactly what happened. Prices per pound went from around $2 to over $10. Revenue grew from $31 million to over $400 million. Pre-tax profits grew from $4 million to over $100 million. Here's the remarkable part. The business required almost no capital to grow. Over 40 years, total reinvestment was maybe $40 million. Everything else was a free cash flow that could be distributed to owners or reinvested elsewhere. That's what a great business looks like. Not exciting growth in units sold, steady growth in revenue per unit because of pricing power, combined with minimal capital requirements. This combination, pricing power plus low capital intensity, is extraordinarily rare and extraordinarily valuable. Most businesses need constant reinvestment just to maintain their position. Equipment wears out. Technology changes. Competitors force you to upgrade. Every dollar of earnings gets plowed back in just to stay in place. That's not compounding. That's running on a treadmill. The great businesses throw off cash year after year while requiring minimal reinvestment. That cash compounds. If earnings grow 10% annually and the business only needs to reinvest 20% of those earnings to maintain growth, 80% is available to owners. That 80% can be reinvested at high rates elsewhere or returned to shareholders. Either way, wealth compounds. So how do you identify these businesses? There are specific characteristics to look for. First, does it generate high returns on capital? If a business earns 20% on invested capital, that means every dollar reinvested produces 20 cents of annual earnings. That's powerful compounding. If a business earns 6% on invested capital, every dollar reinvested produces 6 cents annually. That's weak compounding. Over decades, the difference is enormous. Second, does it have a defensible competitive advantage? This is often called a moat. Something protects the business from competitors. It might be a brand that customers trust and prefer. It might be network effects where the product gets better as more people use it. It might be cost advantages from scale that smaller competitors can't match. It might be regulatory licenses that limit competition. Whatever the source, the moat needs to be real and durable. Third, does it operate in a market with favorable long term economics? Some industries are structurally terrible. They have high capital requirements, intense competition, commoditized products, and powerful customers who can squeeze margins. Airlines, for example, have historically been wealth destroyers despite moving millions of people. The industry economics are brutal. Other industries have favorable structures. They have high switching costs, recurring revenue, pricing power, and rational competition. Fourth, is management competent and trustworthy? You're entrusting your capital to people who will allocate it on your behalf. If they're incompetent, they'll destroy value even if the business has advantages. If they're dishonest, they'll enrich themselves at your expense. You want management that thinks like owners, that allocates capital rationally, and that operates with integrity. Fifth, can you buy it at a reasonable price? Even a great business is a bad investment if you overpay. Price matters enormously. Paying 30 times earnings for a business that grows earnings at 8% annually means you're accepting a very low initial return on your investment. That business might be wonderful, but your returns will be mediocre. Paying 12 times earnings for the same business means you start with a much higher return, and your total returns over time will be much better. These criteria seem straightforward, but implementing them is difficult because it requires patience and discipline that most people don't have. Great businesses trading at reasonable prices don't appear often. You might find two or three compelling opportunities per year if you're looking actively. Most of the time, everything is fairly priced or overpriced. This means sitting on your hands, holding those treasury bills, and waiting. Most people can't tolerate that waiting. Here's what typically happens instead: someone decides to invest. They do some research, they find a few businesses that seem decent, but prices are elevated because the market has been strong. They buy anyway because they had cash burning a hole in their pocket and they feel like they need to do something. The businesses are fine, the prices are mediocre, returns end up mediocre. Then a recession happens, prices fall. The same businesses are now available at much better prices, but now they're scared. They sell at exactly the wrong time. They bought at mediocre prices driven by impatience and sold at good prices driven by fear. This pattern repeats across millions of investors every market cycle. The disciplined investor does the opposite. They wait patiently, holding treasury bills until prices become attractive. They build a list of businesses they understand and would like to own at the right price. When fear creates opportunity, they buy. Then they hold. They don't trade. They don't get clever. They let the business compound. The stock price might fluctuate wildly, but that's irrelevant because the underlying business is generating value regardless of what Mr. Market thinks on any given day. This is not exciting. This is not fun. This doesn't give you stories to tell at parties, but it works. The data on this is overwhelming. Investors who trade less and hold longer produce better returns than investors who trade frequently. The difference isn't small. It's often several percentage points annually, which over decades compounds into multiples of final wealth. Here's a specific implementation framework. Maintain a tight watch list of 10 to 20 businesses you understand thoroughly. Know what they do, know their competitive position, know their economics, know what price would be attractive. Then wait. Check prices periodically, maybe quarterly. When a business on your list trades below your target price, buy it. Then do nothing. Hold it. Let it compound. Ignore the daily price movements. Focus on the business fundamentals. If those remain sound, continue holding. If they deteriorate significantly, sell. Otherwise, sit on your hands. This approach requires almost no time once you've done the initial work. You're not monitoring markets daily. You're not reading analyst reports constantly. You're not reacting to news. You're just checking in periodically to see if any of your target businesses have become attractively priced. Most quarters, the answer will be no. Do nothing. Some quarters, usually during periods of market stress, the answer will be yes. Deploy capital, then return to doing nothing. The hardest part of this approach is the doing nothing. Humans are wired for action. Sitting still feels like laziness. Watching your portfolio do nothing for months or years feels like wasted time. But in investing, doing nothing is often the highest value activity because it prevents you from making mistakes that destroy wealth. Now, we come to the third asset, and this is where everything changes. The first two assets, Treasury bills and great businesses, are important. They preserve and grow financial capital. But the third asset determines whether you'll even have significant capital to deploy in the first place. Your earning power, the present value of all future income you can generate through your skills, knowledge, reputation, and relationships. This is the most valuable asset most people will ever own, and almost nobody thinks about it as an asset. They think about their current salary, they think about their current job, but they don't think about the total present value of all the income they'll generate over their lifetime and how that value can be increased through deliberate investment. Let's put some numbers on this to make it concrete. If you earn $60,000 per year and you work for 40 years, that's $2.4 million of total lifetime earnings before taxes. If you can increase your earnings by just 20% through skill development, better career choices, or building a side income, that's an extra $480,000 over your lifetime. If you can increase it by 50%, that's $1.2 million. These are massive numbers, far larger than most people will accumulate through investing. Now, here's the critical insight. The return on investment in yourself is almost always higher than the return on investment in financial assets. Spending $10,000 on your education, your skills, or your business might generate $50,000 or $100,000 of additional lifetime income. That's a 5 to 10 times return. Finding that kind of return in the stock market reliably is essentially impossible, but it's achievable in human capital because you have direct control and because the leverage is enormous. Moreover, this asset has properties that financial assets don't have. It can't be inflated away. If inflation is running at 3%, your employer will likely increase your salary by a similar amount to retain you, especially if your skills are valuable. It can't be taken from you. A market crash can wipe out your portfolio, but it can't erase your knowledge or your capabilities. It's portable. If you lose your job, your skills and reputation travel with you to the next opportunity. This is why the most successful people, when you study their trajectories, spent enormous amounts of time and energy investing in themselves, particularly early in their careers. They weren't focused primarily on saving and investing money. They were focused on becoming more valuable, more capable, more knowledgeable. The money followed as a consequence of that increased value. Your earning power depends on three factors: skills that are valuable in the marketplace, a reputation for delivering results and operating with integrity, and relationships with people who can create opportunities or amplify your impact. All three can be deliberately cultivated. All three compound over time. And all three create returns far in excess of what you can earn in financial markets. Skills are the foundation. The world is changing constantly. Technologies emerge, industries evolve. What was valuable 10 years ago might be obsolete today. What's valuable today might be obsolete in 10 years. This means continuous learning is not optional, it's mandatory. If you stop learning, you become a depreciating asset. Every year, you know a smaller percentage of what's relevant. Your earning power declines. Eventually, you're replaceable by someone soon. Younger who has more current knowledge. The inverse is also true. If you commit to continuous learning, you become an appreciating asset. Every year, you know more. You can solve problems others can't. You can see opportunities others miss. Your earning power increases. This compounds year after year until the gap between you and those who stop learning becomes unbridgeable. How do you do this practically? The answer is unfashionable and boring. Read. Not skim articles online, not scroll social media. Actually read books, long form articles, research papers, anything that requires sustained attention and deep engagement. The most successful people read voraciously, not for entertainment, for learning. They're building mental models, adding to their understanding, connecting ideas across disciplines. Go to bed every night a little wiser than when you woke up. This seems trivial. It seems like such a small thing. But compound that over decades, and the results are extraordinary. Someone who learns one useful thing per day accumulates 365 useful things per year. Over 40 years, that's 14,600 useful things that someone who didn't commit to daily learning doesn't have. The gap becomes massive, but reading alone isn't enough. You need a system for organizing what you learn. Facts that don't connect to other facts aren't useful. You can't apply them. You can't see patterns. You need a framework, what's sometimes called a lattice work of mental models. These are fundamental principles from multiple disciplines that help you understand how the world works. Understanding compound interest from mathematics helps you think about growth processes everywhere. Understanding incentives from economics helps you predict behavior in all kinds of situations. Understanding regression to the mean from statistics helps you avoid being fooled by randomness. Understanding evolution from biology helps you think about competition and adaptation in business. Understanding cognitive biases from psychology helps you recognize when your own thinking is being distorted. The person who has these models can think more clearly in more situations than the specialist who only knows one domain deeply. And clearer thinking leads to better decisions, which leads to better outcomes, which leads to higher earning power. Reputation is the second factor. Skills make you capable. Reputation makes people willing to work with you, hire you, promote you, refer you, and partner with you. And reputation is built slowly through consistent delivery and consistent integrity. Every promise kept adds to your reputation. Every promise broken subtracts from it. There's no shortcut. You build it one interaction at a time over years. It takes decades to build a reputation and one mistake to destroy it. The asymmetry is brutal. This means you must protect your reputation as if it's your most valuable asset, because it is. Never lie, never cut corners. Never take shortcuts that compromise integrity. The short term gain from any of those is trivial compared to the long term cost if you damage your reputation. Think about the people you most respect professionally. Why do you respect them? Probably not because of their intelligence or their credentials. Probably because they're reliable. They do what they say they'll do. They operate with integrity. They can be trusted. That's reputation, and it's extraordinarily valuable. People will route opportunities to someone they trust, even if that person isn't the most talented option available. The third factor is relationships, not networking in the superficial sense of collecting contacts. Real relationships built on mutual respect and genuine value exchange. The people who can help you when you need help, who can create opportunities, who can provide advice or connections or resources. These relationships are built the same way reputation is built, slowly, through providing value first, through being genuinely helpful without immediate expectation of return. Here's a practical technique that successful people use. Sell yourself an hour each day. Before you work for your employer, work for yourself. Early in the morning, before the day's demands hit, invest 1 hour in building your earning power. Learn a skill, work on a side project, strengthen a relationship, write something, build something. Do anything that increases your value. 1 hour per day is 7 hours per week. 7 hours per week is 365 hours per year. Over a decade, that's 3,650 hours of focused investment in yourself. What could you become with 3,600 hours of deliberate practice and learning? The answer is probably extraordinary in whatever domain you choose. Most people don't do this. They wake up, check email, respond to urgent demands, and spend their entire day reacting to other people's priorities. They're busy, they're working hard, but they're not investing in themselves. Their skills stagnate. Their earning power plateaus. Then they wonder why they're not advancing, while others who seem less talented are pulling ahead. The ones pulling ahead are the ones investing in themselves systematically. They're not smarter. They're not luckier. They're just compounding their capabilities while others aren't. Now let's connect all three assets back to the original problem. Cash in the bank is dying. You need alternatives that preserve value, grow value, and compound over time. Treasury bills preserve value while you wait for opportunities. Great businesses grow value through pricing power and capital efficiency. Earning power is the foundation that enables you to generate capital to deploy in the first place and to make intelligent decisions about where to deploy it. These three assets are not separate strategies, they're one integrated approach. You invest in yourself to increase your earning power. That increased earning power generates more income. You live below that income to create a gap. That gap accumulates in treasury bills while you wait for opportunities. When great businesses become available at attractive prices, you deploy capital. Then you hold. You let the businesses compound. Meanwhile, you continue investing in yourself, which continues increasing your earning power, which continues generating more capital. This is a flywheel. Each component reinforces the others. Higher earning power generates more capital. More capital creates more opportunities. Better investment decisions generate better returns. Better returns create more capital. More capital creates more security. More security creates more freedom to take career risks that might further increase earning power. The cycle continues. Most people never build this flywheel because they violate one or more of the principles. They increase spending as income rises, so no gap forms. They deploy capital impatiently into mediocre opportunities, so returns are poor. They stop investing in themselves after formal education ends, so earning power plateaus. They make one or more of these mistakes, and the flywheel never gets momentum. The person who gets all three components right, even if they never achieve perfection in any single component, builds substantial wealth over time almost automatically. It's not about genius. It's not about luck. It's about understanding what actually drives wealth and doing those things consistently. Your cash in the bank is dying right now. Every day it buys a little less. That's mathematical reality. You can continue letting it die while feeling safe because the number doesn't change, or you can deploy it into assets that preserve value, grow value, and compound over time. Treasury bills for waiting, great businesses for compounding, and most importantly, investment in yourself for generating the capital that makes everything else possible. The choice is yours. The tools are available. The question is whether you'll actually use them.